Okay, let's get started. Good afternoon, everyone. I'm Alberto Rossi, Associate Professor of Finance and Associate Director of the Center for Financial Markets and Policy at Georgetown. Welcome back to our seminar series on FinTech. Before we get started, let me remind everyone of our annual conference, which will take place over the week of November 16th. You will find more information in the chat. And let me also thank the Director of the Center, Rina Agarwal, the Executive Director of the Center, John Jacobs, and the Assistant Director of the Center, Anna Kormis. Today, I'm extremely excited. We have Man versus Machine Day. We have 3 great papers comparing the forecasts generated by machine learning algorithms to those of humans in predicting stock earnings in the first 2 papers, and then patent quality in the last paper. And without further ado, let me leave the virtual floor to Jules, who's going to present the paper Man versus Machine Learning, the term structure of earnings expectations and conditional biases. As a reminder, Jules will talk uninterrupted for 20 to 25 minutes. We will then have 5 to 10 minutes for questions. You can raise your hand or write your question in the chat. We have Jules co-authors as well in the audience, so they may be helping answering some of the questions. But without further ado, now I see that Jules has already shared his screen. So Jules, go ahead, you have 25 minutes.
Wonderful. Thank you so much for inviting me to be here today. So the paper I'm presenting today is called Man versus Machine Learning, the term structure of earnings expectations and conditional biases. And it's joint work with Xiang and Alejandro Lopez Lira. Alejandro is online. Xiang unfortunately couldn't join us, but I do want to say that he is on the job market this year. And so I encourage everybody to look at his packet. I highly recommend him. All right, so what is the big picture question? When we look at earnings forecasts, you can ask the question, are these earnings forecasts statistically optimal? Are these analyst forecasts biased? If so, in what direction? If they are biased or if they're not statistically optimal, are there better ways to forecast earnings? And can we come up with a better benchmark? Now, of course, there are 2 ways to go about this question. One is to simply say, well, can we just look at the forecasts that these people make and then compare them with the end results and see on average whether as a group over a particular horizon, the analysts were upward or downward biased. But what would be even better is if we could come up with a better forecasting model so that in real time at each point in time, we can compare the forecast that the analyst has made to some other benchmark. Because that allows us to get a time series and a cross-section for stocks of conditional biases, meaning at each point in time for each horizon, for each stock, we now know how much the new benchmark deviates from the analyst forecast. And then, of course, if we have that, we can do things with that measure. We can do things like sort stocks into portfolios based on pessimistic and optimistic forecasts and biases. And we can also look at firm managers and see what, in terms of the corporate actions that they have, how they would respond to these deviations. And so, of course, the benchmark that we're going to be using for that is going to be a machine learning benchmark. So the question is, can machine learning beat analyst forecasts? And then, as I already said, we're going to then see whether or not these analyst forecasts matter for market participants and firm managers. In other words, suppose that everybody looks at these analyst forecasts the way they're provided, but everybody perfectly understands that there's an issue with them. And therefore, suppose that everybody's already aware of even the conditional bias for each stock at each point in time for each horizon that these earnings forecasts have. Then, of course, sorting by our measure and sorting stocks into portfolios is not really going to do much because these biases are perfectly priced in, and therefore we wouldn't expect to find any differences in average returns. If on the other hand, people take the analyst forecast seriously as if they're accurate forecasts, despite the fact that they have problems, then of course we should find that if we sort stocks based on these bias measures, we should be able to generate portfolio returns that increase or decrease in the biases that we're seeing. So similarly, we can see whether firm managers are cognizant of the fact that the earnings forecasts are biased. And so particularly, we're going to look at stock issuance and repurchase behavior and see whether these conditional biases, the differences between the analyst forecast and the forecast that our machine learning forecast is providing, is going to be informative and correlated with these actions that firm managers have. Now, of course, statistically optimal earnings forecasts expectations are important and interesting in their own right, right? Even if we wouldn't do these last two exercises, it seems that if we can provide market participants, particularly less sophisticated market participants, with better earnings forecasts measured that on average are not biased, that would already be a victory. But of course, we're going to take it one step further, and we're going to show that actually these biases do seem to matter, both for asset pricing and for corporate finance. Now, as I already said before, if you simply compare the forecast with what eventually realizes, you can exposed conclude whether or not on average these forecasts were biased, yes or no. But of course, that's not going to be very helpful for us in terms of the sorting that we want to do. We want to have a conditional real-time measure at each point in time so that we can actually look at actions in the information set at time t. And for that, we need a real-time benchmark, which is going to be our machine learning benchmark. So for the first other benchmarks used, as we said, exposed realizations. Now, of course, there are also people that simply don't use a benchmark. They simply use the forecasts themselves in the regression. And so then, of course, essentially, you're just putting in a measure of expectations, whether or not it's biased or not. There's also quite a literature that is thought about linear forecasting rules. But of course, there's no particular reason to assume that a conditional expectation is a linear function of particular forecasting variables. And so if you do linear forecasts, particularly with a lot of variables in the linear forecast, the question then, of course, is, does this work out a sample? And so what we're going to show is that the machine learning algorithm that we're going to use is particularly designed to deal with nonlinearities and to deal with large potential inputs of which you want to pick only a few. So we're going to use machine learning. We're going to construct a statistically optimal and unbiased benchmark for firms' expectations available in real time. The main tool in the machine learning that we're going to use is called random forest regression. As I said, it has two main advantages. It naturally allows for nonlinear relationships between the variables, and it's designed for high-dimensional data, which mitigates the risk of in-sample overfitting. Of course, the ultimate test is always simply going to be, does it work out of sample, yes or no? And therefore, of course, we're going to test this out-of-sample performance. And then the two applications that we're going to do with these better earnings expectations are going to be stock market return sorting and corporate financing decisions, such as issuing and repurchasing stock. So what is the main finding? Well, we do find, and this is consistent with what other people had in the past, particularly based on the exposed realizations, that indeed analyst earnings expectations are biased. And particularly, they seem to be on average biased upwards. But we're also going to show, now that we have these conditional measures, that there is a large time series variation in the degree of this bias, but also that there's large cross-sectional variation between different stocks in how big this bias is. And of course, that's exactly the time series and cross-sectional variation in the bias is exactly what we're going to be using in our exercises. So the bias is larger the further away the forecast is. Now you may say, doesn't that make sense? Isn't that always true? Well, of course, first of all, that there is some forecasting error. That seems perfectly normal, and we should always have that, right? And it should also be the case, clearly, that the forecast error that you make is probably going to be larger the further away the horizon is. But there's no reason for why the bias should be larger and a function of the term structure, if you will, where the further away you are, the more biased you are. Now, you could think of a model where you say, well, if there is bias, then at some point, reality is going to force you to decrease your bias, although there's no particular reason why that would have to be true, but we're going to be showing you that that indeed seems to be the case. So we're going to find that analyst biases are indeed associated with negative cross-sectional return predictability, exactly the way that you would expect, which is that optimistic forecasts leads to overpriced stocks, leads to underperforming stocks in the consecutive periods, and vice versa. So analyst forecasts that are too pessimistic, prices are too low, returns are going forward higher. And then secondly, we're going to find also what you would expect there, which is that managers of firms seem to be, at least, let's say it this way, we cannot prove that they seem to be aware, but at least the actions that they perform seem to be consistent of them being aware. Meaning, if the earnings forecasts are overly optimistic, that means that the pricing is overly optimistic, which means that the managers will issue more stock, and vice versa. Now, of course, there could be a third underlying reason for why these two things are correlated, that the way that the analysts are doing the forecast somehow correlates with the actions of the manager, other than through the fact that the manager simply realized that their stock is overvalued or undervalued. But at least our story is consistent with them being aware. So what do we want to forecast? We want to forecast earnings per share. We have the analyst forecast. So obviously, as I will show you later, it would not be optimal to exclude the real-time available information that the analysts have in the information set. Now, if the analysts were already doing the right thing and therefore already had a statistically optimal benchmark, then that would simply mean that there's not much for us to add in terms of other variables. And particularly if we would add other variables, they would just really erode the out-of-sample performance, because we're just overfitting in sample and not helping at all out of sample. The forecast horizons that the analysts provide is 1 quarter, 2 quarters, 3, and a year, and then 2 years ahead. And so those are then also going to be the horizons over which we want to employ our machine learning forecasts, so that we can see whether at these 5 horizons we can do better than the analysts are doing. So the method is supervised machine learning. I'm going to, and particularly random forest regression. I'll dive in a little bit to give you a sense of how this works, right? Because certainly before starting to work on this project, I learned a lot about it by working on this project with Alejandro and with Xiang. So, of course, the best forecast is the conditional expectation. Machine learning is a novel and flexible way to approximate these conditional expectations. And what it, of course, does depend on is what information do you feed the algorithm. Now, one advantage is going to be that you can feed the algorithm with a lot of potential variables, and the algorithm itself will make optimal trade-offs to try to get out of sample, well, I should say it differently, to try to get the best conditional expectation without overfitting, right? And the out of sample performance will prove whether or not that's the case, and will show that indeed it does a very good job at this. So it should be possible for the algorithm. Linearity is too restrictive. So the random forest regression is a very nice way to naturally get nonlinearities in there. And I'll show you in a second through the decision trees of how that exactly works. Okay, so here it comes. So the idea of random forest regression is that you recursively split the data into non-intersecting regions, one predictive variable at a time. So let me give you an example. Suppose first that equivalent to regressing something on a constant, you put nothing in the information set other than the mean. So you then just get that the value that you see in the top box there, the average is then 1.211. You have not used any information yet. Now, the first thing you're going to do is you're going to find one variable that is going to help us best reduce the mean squared error of the forecasting error that we have. Now, how do you do that? Well, we're not going to fit a linear function. We're simply going to say, and this is these non-intersecting regions. In this particular case, take the adjusted analyst forecast of the EPS, find one cutoff point, in this case, minus 0.206, and then make a forecast if that variable is above the cutoff, and a forecast if it's below the cutoff. So you simply now split it into 2 regions where you best predict the earnings per share for one versus the other region. Right? So, and you see there the true and false arrows that help you to decide in which of these 2 you are. And then you see there what the value is. So if indeed the adjusted analyst forecast for EPS is smaller than minus 0.206, then we're forecasting that the earnings per share are going to be minus 0.222. You see that there in the second box on the left. If it is going to be above that cutoff, the value is going to be 3.23. You see there then what the mean squared errors are that we're working with, which of course are reduced compared to what we saw before. And then next you can choose what your next non-intersecting region is. Now, one thing you could do is say, well, I want to split adjusted analyst forecast earnings again in 2 regions, and I want to keep working with that variable. Or what you can do, you can say, well, no, actually now let me pick another variable that best helps me reduce the mean squared error. In this particular case, the price to book ratio under the true scenario in the decision tree and the short-term debt in the false scenario. Again, there's a cutoff point. You split the data again into 2 regions and you forecast the values of the earnings per share for those non-intersecting regions. And then you keep going like this. Now, the length of this decision tree is what's called the depth. And of course, the depth, if you think about it in terms of linear regression, the equivalent is if the depth of the decision tree becomes too deep, then we're overfitting, right? Because we're putting in too many decision variables. So what we want to have is we want to sample from a large set of small decision trees, and we want to train the algorithm such that we're going to pick and sample from these very short decision trees that don't have too large a depth to make sure that we're not overfitting the data. Okay, so there's only one parameter so far, which is the depth. And if we pick too large a depth, then we tend to overfit, which means that in sample things will look great, but out of sample, of course, things won't work. If we pick too low a depth, then of course we're neither achieving good in sample or out of sample predictions. To just think of the most extreme scenario where you only pick a constant and you don't have any predictive information. That is the shortest depth that you can possibly pick. Okay, so what are we going to do? We're going to bootstrap a large number of small decision tree. Each decision tree is trained on a different subsample and with different predictors. And then we're going to pick these decision trees and the parameters in a data-driven way. We're going to train the algorithm using rolling windows, and we're going to see how well then these machine learning forecasts for earnings using these random forest regressions are going to help us better predict earnings. What is the data that we're going to use? Well, of course, earnings per share, that's the variable we're predicting. Then we're going to pick analyst forecasts from IBIS. We're going to capture standard input sources for stock prices and returns from CRISP, firm fundamentals from CompuStat, and then a large number of macro variables as well that the algorithm can pick from. Now, what you see here is, this is not a new picture to our paper. What you see here is simply what the realized bias is. Right? So on average, how off were the analysts? And you see there, indeed, that on average, we're talking about positive lines, meaning that on average, the analysts are too optimistic. Then you also see that this optimism generally seems to decrease with the horizon, of course, with the exception of the big spike there that you see. But for the red line is the lowest line. And so 2 years ahead, the purple pinkish line is generally on the top. So this already shows you that analyst forecasts on average are biased. But now what next we want to do indeed is fix this stock by stock in real time. So here in this picture, you see what the conditional bias is, which means we're going to compare the analyst forecasts with our best forecast from the machine learning algorithm that is available in real time. Everything that we're doing is out of sample. And so you see here again that the 2 pictures are markedly different, right? They're not showing the same pattern at all. But more importantly, this picture that you see here is actually in your time t information set. The other picture you can only make after you've seen what the realization of the earnings is. This picture you can make using the real-time forecasts that we have and compare them with the analyst forecasts. Right? So you see that in real time, a lot of these biases are going to be fixable, and I'll show you some evidence later that indeed our machine learning forecasts no longer have this average bias problem that the analyst forecasts alone have. So here, You see the updates in the analyst beliefs against the realized values. So the main thing I want you to take away from this picture is you should read it from the bottom. So 7 quarters, 6 quarters, 5 quarters, and so forth. The main thing to see is that, of course, the squared forecast error is going to be decreasing, as I said earlier, right? Because that's also because as you get more information, then of course the mistake that you make on average is going to become smaller. But most importantly, the forecast error not squared, which is on average how much you're off, that is the bias, is indeed decreasing in the forecast horizon. Okay. So as I already said, analyst forecasts are available in real time, so we can include them in the model. So that of course does mean that in sample, any forecast that we produce will by definition be better, because it's the same as running an in-sample regression where you put more variables in the equation, in the regression. Of course, you're going to get a higher in-sample or squared, but of course, there's absolutely no guarantee that putting in more information is also going to get you a higher out-of-sample or squared. So that's going to be the real test, of course. Now, there's one more thing, and it's really a detail that doesn't really matter for much, but I still want to make sure I've mentioned it, which is analysts report estimates in earnings per share, but of course firms have different numbers of shares, and so that's somewhat of an arbitrary scaling factor. And so we want to make sure that we fix that. And so what we're going to do is you need to scale by something to make things stationary. So we're just simply going to scale everything by the lagged price before the forecast date. So you just pick something that is in the time T information set that is the same for everything, but that makes things stationary, right? So each stock has its own price, lagged price. That is also a price per share. And so therefore this whole per share arbitrariness is being substituted out. You can also do assets per share, and we essentially get the same thing. So there's nothing particular about using this scaling variable that seems to be driving our results. So in this table, you then see by horizon, that's going to be the left column, 1 quarter, 2, 3, 1 year, and 2 years ahead. You then see ML as machine learning. I still have to get used to not reading it as maximum likelihood, but it is really ML really stands for machine learning. Analyst forecast AF and actual earnings AE. And so we take the difference between these things. So then if you look here in the second to last column, you see the analyst forecasts minus the actual earnings. You see there the bias and you see the T-stat on the bias. If you compare that with the machine learning minus the actual earnings, you see that essentially none of the deviations that we're getting on average are going to be statistically significant. So it seems that we have resolved the bias issue by using machine learning versus using these analyst forecasts. And then also you see here what the mean squared error is, if you will, and you see that we get lower mean squared errors, and the gains increase as the horizon becomes bigger. Now, of course, when it comes to stock pricing exercises, the net present value of a stock gives you access to a large perpetual stream of cash flows. So the long horizon forecasts are, of course, more important for the stock pricing, because that, if you think about, say, Gordon growth, and you want to get a sense of what the growth rate, the G, is, of course, the long horizon earnings forecasts are more important. So the fact that these biases become worse as the forecast horizon goes up is not good for stock pricing. And that, of course, is one of the reasons, arguably, why later, when we're going to sort stocks by the biases, we're going to find out that this has a cross-sectional return predictability. Okay, so I'm quickly starting to run out of time, so let me hurry up a little bit. So analysts are biased relative to the machine learning forecast. Does the market price in this bias? As I said earlier, the fact that we're going to find this return predictability suggests that at least the market doesn't fully price it in, right? Secondly, firm managers do seem to understand the forecast and market prices are to some extent still biased and are therefore more likely to issue stocks. This is not too surprising, right, in the sense that you would expect firm managers to have better information and to be better informed. Now, of course, given the fact that we, with public information, can fix the bias, it is still, of course, puzzling why other investors are not fixing this, or more importantly, and I can already give this away in the sense that we are not solving the problem in this paper for why the analysts do what they do. Why do they have biased forecasts? Now, there are papers in the literature, and we've cited them in the paper, that essentially argue that analysts have incentives to be overly optimistic in the way that they're compensated. You can, and the way that reputations are formed, you can see that there are theory models that would predict that it's optimal for them to be too optimistic. But of course, then the question is, well, why wouldn't investors understand that incentive problem and simply fix the analyst forecasts for these biases already? Right? And so that is a question that our paper does not answer. We are just showing that this cross-sectional return predictability exists. So we're going to do two primary return predictors, the average bias and the biased score, which is essentially a ranking of where you are in the bias. I'm not going to spend too much time on this. We're going to do the standard Feynman-Macbeth regressions, but we're also going to do the standard portfolio sorts. And what you see is that you get these monotonic return patterns, where the average return differences are actually very large. Now, to put this a little bit in context, we thought that these return differences were very large. So one robustness that we did was simply ask the question, suppose that you as an investor knew the realized earnings as the only one beforehand. What types of returns should you expect if you sorted portfolios that way? And those portfolio returns are really, really large, much larger than this. Another way of saying that is, being right on earnings and knowing them better than other investors really allow you to get a competitive advantage in financial markets. So if you can fix these biases, then quickly you can earn outsized returns. So you see that it doesn't matter whether we do this ranking the BE score or the average BE, that is all the same, right, in terms of the results. What we're finding is that there are some interesting loadings on sort of the common factors that people use. So those loadings are reported here. And there's one extra thing that I think is worth mentioning, which is that apart from these factors that you see here, there are, of course, many, many other anomalies. And what we show in the paper is that there are indeed several other anomalies for which our earnings expectation bias measure it seems to be driving particularly the short leg of a lot of these other anomalies. So this earnings expectations problem seems to be related with quite a few anomalies in the literature. Okay. What about stock issuances? Managers have at least as much information as the investors. As we said, they have public and private signals. We're going to show that managers simply issue more stock when the biases are larger. As I said earlier, this is not causal evidence. We're just showing that larger biases are correlated in the direction we would expect with firm manager actions. That doesn't know that they know it for sure. It just says that what we're observing is consistent with them knowing it. There could be other explanations, and we're open to other suggestions for, say, a common underlying factor that could drive both.
2 minutes, Jules.
Yeah, I'm just gonna conclude. So a couple things. So first, I think we have a nice new benchmark for earnings expectations. I think the measure works well out of sample, fixes the bias problem that the analyst forecasts has. I think it's a interesting new technique. I think it's I think particularly in asset pricing. I think we're very much and in corporate finance as well, for that matter, we're very much addicted to linear regression. I think with the good reasons for that too, but I think this is an interesting new way of getting nonlinear relationships well estimated with good out of sample performance in a completely data-driven way, right? So particularly when you do linear regressions, and we have some of those problems in our field, which is that from previous papers, you often know already what variables you're supposed to put in, right? And so then that even raises the question, what does out of sample really mean when you've already looked at other papers for which you know things work? The advantage of this, I think, is that you can feed the algorithm with essentially all the information that is there and let the data decide what to put in at each point in time. So I do think that adds a level of objectivity to the whole process, if you will. I think I've run out of time. So thank you for listening and for being there. Thanks.
Thank you. Yeah, thank you so much, Jules, for the fantastic presentation. We have a couple of questions, but first I have a question myself. So one of the things that I think is a big misconception, many people believe that these machine learning tools are kind of black boxes, they are impenetrable. And I think on the other hand, like a random forest or any tree-based methods has the huge advantage that you have relative influence measures, partial dependence plots. So you have all these diagnostics that tell you which variables matter the most, what is the conditional, or basically what is the effect of each variable integrating out the effect of all the other variables. So do you explore this and tell in the paper report which variables matter the most, yeah, or the partial relation, the non-linearities you document?
Yes, absolutely. So it's certainly, so just to give a little more context, indeed, thank you for bringing this up. I didn't have time to put this in the presentation, but it is in the paper. So indeed, you can simply ask the question, how much a particular variable has contributed in that whole process to reducing the mean squared error of the forecast. And so in that sense, you can very much interpret that as a partial R squared or an R squared type thing where you see how much each variable contributes. And so in the paper, we have a breakdown there where we show how important market related information is. Macro information, for example, doesn't turn out to be as important as I had thought beforehand it would be. And of course, we're going to find that the analyst forecasts are an important part of information. The algorithm is heavily relying on that. But then using the other variables to fixing the problems, right? And so I do think that there it's also important in the sense that when we have multivariate regression, you always need to be very careful in terms of how you interpret the coefficients that you're getting, right? And so something similar holds here, which is that once you, if suppose this was a regression, once you put in the analyst forecast, the other variables that you then put in are simply going to be used to fix the problem that the analyst forecast has. And so that's exactly what the machine learning algorithm is going to do too. It's essentially going to, given the fact that the algorithm relies heavily on the analyst forecast themselves, it's going to pick the other variables to fix the bias. And so you can see in these influence measures, indeed, you can see which variables the algorithm picks to accomplish that.
Perfect. Thank you so much. And so we have one question from Neil Stockton. He's asking, how is it possible to earn abnormal returns if the firms issue stocks when it's overpriced and therefore counteract the bias?
No, I mean, clearly, if it was the case that the only person that is shorting is going to, or taking that side is going to be the firm manager, then obviously that happens at a completely different frequency than the frequency at which you can trade. So there's totally room for both. There's room for the firm managers participating in this process of betting on the stocks that are overvalued, but that doesn't mean that they totally erode the rents and that there are no rents available for other investors. And more importantly, of course, also on the long side of things, in terms of when the stock is undervalued, buying the stock, of course, can be done at a much higher frequency and more intensely than repurchase programs. So I think they operate at an entirely different frequency, and so I think there's room for both.
Thank you so much. I think we are already out of time, but thank you for the fantastic presentation. I think there is another question coming in the chat, but I think we have to move forward with the next presentation. The next presenter is Joe Pacelli from Indiana, and he's going to present Man versus Machine, a comparison of Robo-Analyst and traditional research analyst investment recommendations. Joe, you can take it away. You have 25 minutes.
Thank you.
Well, thank you so much for having us today. It's really great to be here to present our research. Continuing along the theme of man versus machine, we'll be talking today about comparing robo-analysts with traditional research analysts. This is co-authored work with Ken Merkley, who's also at Indiana University, and our doctoral student, Braden Coleman. Ken is also on the call today as well. So the backdrop for this study is we've seen in recent years that there's been a lot of advancements in fintech, and these advancements are revolutionizing product offerings across the financial services industry. And so as of 2018, there's been more than $50 billion invested in nearly 2,500 startup fintech companies. So we have recent evidence that fintech appears to be benefiting end users, at least based on lending and brokerage activities, but we have very limited evidence of how this is working in the research space. And so why do we think that this is important? Well, there's at least two reasons why this might be important in research. First, we've seen a trend in recent years that research budgets have becoming increasingly constrained. And a lot of this is due to MiFID II. We're starting to see that the decoupling of the costs are leading to more constrained budgets. At the same time, we're also seeing that the cost of actually doing the job of an analyst is becoming higher as well, because public disclosure is becoming more and more difficult to process as 10Ks get longer and disclosure gets more complex. So we believe this is an area that is research is an area that is actually ripe for disruption, where fintech could potentially have a lot of benefits. So what we do in this study is we provide the first large-scale empirical investigation of the properties of the investment recommendations of what we call robo-analysts. And so this is a descriptive exercise, and we define a robo-analyst as a human analyst assisted computer program conducting automated research analysis. And so what we're going to do is we're going to construct a data set that allows us to track the activity, recommendation revision patterns, and investment value associated with approximately 75,000 reports issued by 7 prominent robo-analyst firms over about 15 years. And we're going to develop and assess 3 distinct empirical predictions related to the differences between robo-analysts and traditional human analysts. So what is the robo-analyst advantage? So when we think about a robo-analyst, they actually provide a rather straightforward value proposition. They provide research reports that are purportedly comprehensive and also unconflicted. So this is a figure here from one of the robo firms we actually had an opportunity to visit in our sample. This is New Constructs. So we can see that this is how New Constructs compares themselves to their competitors. So we can see that first of all, with respect to being comprehensive, New Constructs produces research that has a wider set of features. We can see that they have cash flow focus, consistent due diligence. They provide transparency links to SEC filings and calculations. So our premise here is that robo-analysts have the advantage of being able to collect and parse large volumes of financial reports and rapidly integrate this detail into their models. And they're not going to be limited by cognitive constraints that traditional analysts potentially face, things such as limited attention or fatigue. So the first advantage is that robo-analysts potentially have a more comprehensive offering. Second, we saw this discussed in the first paper a little bit as well, is that robots potentially are less conflicted, which is going to lead to less biased research. Why is that the case? Well, robo-analysts are programmed to follow a strict set of rules and are less subject to behavioral biases and conflicts of interest, such as related to investment banking or trading revenues. It's important to note here too that we're not going to say that the only type of bias that traditional analysts face is due to incentives. It's also the case that the analyst truly faces behavioral bias, such as something called the rose-colored glasses phenomenon, where they truly believe in the stock that they cover despite its prospects. So we see here that the sample from here, New Constructs, when they compare themselves to their competitors, you can see that they're arguing they're not conflicted because their research is not paid for by the companies or funds they covered, and there's no influence on banking or trading. So what we're going to do is we're going to test 3 distinct predictions regarding differences between robo-analysts and traditional analysts based on the purported benefits of what we call automated research. We're going to try to see how predictions relate to this idea that robo-analysts are comprehensive and less conflicted. So the first set of predictions we're going to consider relates to the robo-analyst output. And we're going to predict that robo-analysts produce a more balanced distribution of recommendations. So what we see is the traditional analyst has a distribution of recommendations that's very skewed towards the buy, lots of buys, some holds, and a few sells. We're going to predict that the robo-analysts, because they're less biased, less conflicted, they're going to have a more even distribution of recommendations, perhaps more evenly balanced between buy, hold, and sells. Next, we're going to explore the process of the robo-analyst. Here, we're going to argue that robo-analysts are going to be able to leverage technology to do a very different type of job than the traditional human analysts do. We're going to predict that they're going to revise more frequently. They're going to be less subject to having stale recommendations, a criticism of human analysts. And they're also going to be able to incorporate more information from public disclosure. They're going to be able to rapidly update their models because they have algorithms in place to feed from these disclosures. And then finally, perhaps most importantly, we're going to assess the investment value of robo-analyst recommendations. Here, we're going to see whether this output, this more balanced output and improved process actually generates benefits from investors, here we're going to expect that robo-analysts are going to ultimately provide more profitable investment recommendations. Okay, so to briefly preview our results, what do we find? Well, first of all, with respect to robo-analyst output, we do find that it produces very less biased recommendations. So we see here that robo-analysts are going to be 14% less likely to have an outstanding buy recommendation in our sample. On the contrast, they're 16% more likely to have an outstanding sell recommendation. We're going to also conduct some analysis to try to figure out why is that the case? Why is it the case that robo-analysts have more outstanding sells if you're outstanding buys? We're going to provide some evidence to show this is not fully explained by business model. In other words, we're going to conclude that robo-analysts actually do face fewer cognitive biases. Next, we're going to explore the research process here. And here we're going to see that robo-analysts do indeed adopt a very different research process than do the traditional human analysts. They revise more frequently in our sample. They're less likely to piggyback off an earnings announcement, which is a frequent criticism of human analysts, that they traditionally revise after the earnings announcement, provide a report that doesn't have much value. Our robo-analysts instead are going to be more likely to revise following a 10K release and incorporate the information in that public disclosure. And then finally, with respect to investment value, we're going to find a very interesting findings here, I think. So we're going to find that overall, you can make profit off robo-analyst recommendations. They are profitable, but you're not going to see that in the short run reactions. So we find very limited short run market reactions. And we have several explanations for this. It's potentially due to something called algorithm aversion, which I'll talk about in a little while. But then the plus side, though, we do find that if you form portfolios based on the buy recommendations of robo-analysts, they do indeed outperform traditional analysts. Okay, so let's talk about the data first. So what we did to get this data is we went to Thomson 1, and we were able to actually download the reports from all our research providers on there. And then we manually went to each of those providers' websites to verify that their business models actually relate to something that looks like automated research. So again, here's New Constructs, one of the firms that we actually were able to visit in our sample and actually see what they were doing. You can see here that New Constructs, when they advertise with their process, they're saying that they use the latest in machine learning to analyze structured and unstructured financial data. And they develop proprietary NLP tools and financial models using this data. So we verify for each of the firms in our sample that they are using an automated research process. And so what we're able to do here is we're able to land on seven robo-analyst firms over a period of about 15 years, starting in 2003, going through 2018. And one of the design choices we make here, as we're talking about, is that we focus on an overlapping sample based on IBIS coverage. So we're focusing on robo-analyst firms who are also covering the same firm that a traditional analyst is covering. And why do we do that? Well, we want to be able to make comparisons holding constant the firm and the year. For example, we want to see how the robo-analyst recommendation for Microsoft in 2010 contrasts with that of the human analyst. So that's a benefit for our research design, but it does come with one cost in that our paper does not at all speak to the coverage of robo-analyst firms. It does not overlap with human analysts. So it could very well be the case that robo-analysts do cover firms that human analysts don't cover. We're not going to be capturing that or studying that in this paper. So our final sample contains about 76,000 robo-analyst reports. So the basic regression framework we're going to use for at least the two parts of our studies, we're going to be regressing the outcome related to analyst I covering firm F in time t on a dummy for whether or not that report or recommendation is issued by a robo-analyst, takes the value of 1 for a robo-analyst, 0 otherwise. We're going to have some firm level controls in here like size, profitability, and book to market, but our most powerful tests come from the inclusion of firm cross-year fixed effects, because that's going to control for all characteristics of the covered firm, time varying firm heterogeneity. The outcomes we're going to be considering here, with respect to the output, we're going to first look at the outstanding recommendation, whether or not there's a buy, hold, or sell at the end of the year. And then we'll separately look at indicators for buy and sell. With respect to the process, we're going to look at the number of annual revisions that the robo-analyst firms and the human analysts produce, as well as the percentage of those revisions occurring in an earnings announcement window or an SEC filing window. And again, the big feature here is we're going to include firm year fixed effects. So really the differences are all within firm year. Okay, so turning to the first part of our study, understanding differences in robo-analyst outputs. So what do we find? So first of all, we can see from the initial descriptive evidence that robo-analysts have far fewer outstanding buys and more outstanding sells than do traditional analysts. So here we see the robo-analysts and traditional analysts and the number of outstanding recommendations, and then we break it down to the percent buys outstanding, holds, and sells at the end of each year. We can see that our robo-analysts have on average 32% for their recommendations or buys at the end of the year, and 24% are sells. When you turn to the traditional analysts, we start to see that there's far more buys, 47% versus 32% for the robots, and also sells, as confirmed by prior literature, are very rare. In the case of our sample, 6% of outstanding recommendations from traditional analysts are sells. So we next turn to a regression framework. And so here we're going to regress the level of recommendation on the dummy variable robo-analyst. In column 1, we'll have no controls, and then we'll add firm controls, followed by firm and year fixed effects separately, followed by firm cross-year fixed effects in column 4. And so we find across all 4 specifications a negative and significant loading on the robo-analyst dummy, indicating and confirming the prior univariate evidence that robo-analysts do indeed produce less optimistic recommendations. It's easier to think about the economic magnitude here by separately looking at dummy variables for buy and sell. So in this regression, we're going to look at buy recommendations, an indicator for whether or not the robot has a buy outstanding at the end of the year. We can see that robo-analysts are about 15% less likely to have an outstanding buy at the end of any given year in our sample. And on the flip side, when we turn to sells, we can see that when we run this regression with a dummy variable for sell, we can see that robo-analysts are about 17% more likely to have a sell recommendation outstanding at the end of the year. So the initial evidence is really pointing towards robo-analysts having a much more balanced distribution of recommendations. So why is that the case? That was something we were really interested in kind of digging into. Unfortunately, the processes are really unobservable to us, but we can try to roughly get a rough sense of what's going on. So we thought of 2 potential reasons why robo-analysts issue less optimistic recommendations. One is it could be due to business model differences. Maybe they're just simply less conflicted because they don't have any investment banking or trading business. Or maybe it's actually due to them actually facing fewer behavioral cognitive biases. So how do we try to differentiate between those 2 explanations? What we do is we examine a subsample of human analysts that work at smaller research firms. And the rationale for looking at small research shops is that these are traditionally more likely to be independent research shops that also don't have investment banking or trading business. So there's similar business models to the robots. So now our comparison group is going to be another research firm that has a similar business model. If we still find differences, it seems more likely that we're attributing that to differences in behavioral cognitive biases of the robo-analysts compared to the human analysts. So what we find here is in this subsample, when we compare the robo-analysts to the smaller research shops, those are the ones more likely to be independent research shops, we continue to find our results hold here. So we think this at least provides some indirect evidence pointing towards differences in behavioral biases, explaining why robo-analysts produce less biased recommendations. Okay, so we next move on to understanding differences in the robo-analyst research process. So the evidence thus far indicates that robo-analysts differ pretty dramatically from traditional human analysts with respect to the properties of the investment recommendations they produce. We next want to understand, how does their process differ? And so we thought about this with respect to the quantity of output and the timing of output of the reports that robo-analysts produce. So here we expect that the automation that robo-analysts can be able to leverage will allow them to produce more revisions, less likely to have stale reports. They're going to be less likely to rely on earnings announcements, and instead are going to update more likely to update following SEC filings. So this should really be their key advantage, being able to come back and actually produce a report quickly after a public disclosure, public filing. So in this regression here, what we consider first is we regress the number of revisions a year on the robo-analyst dummy. And we find across all 4 of the specifications we consider, robo-analysts positive and significant loading, indicating that robo-analysts are produce more revisions per year than human analysts. In terms of economic magnitude, we're looking at about almost 1 more report per year, which is actually quite a lot in our sample, because I think our human analysts only do about 1 to 2 revisions per year on average. So this is a pretty big increase from what the human analysts are doing, because we're looking at recommendations, not earnings forecasts, which are revised more frequently. We then consider, well, what percentage of those revisions are happening around the earnings announcement date? And here we see a negative loading. We see that robo-analysts are less likely, about 7% less likely to issue a recommendation revision. And I think it's a 5 or 10 day window surrounding an earnings announcement. But on the flip side, when we look at SEC releases, in this table, we regress the percentage of revisions occurring around an SEC window on the robo-analyst dummy. We can see that they're more likely to revise following an SEC report. So it confirms our prediction here that the robo-analysts, their key advantage is in incorporating information from public disclosure. That's when we see them revising, not around earnings announcements. Okay, so the last part of our study turns to the investment value of robo-analyst recommendations. And so just to recap, what have we found so far? Well, we found that robo-analysts have less biased recommendations, that they revise more frequently, that the timing of the revisions is quite different. They revise less often around earnings announcements and more often around SEC filings, but maybe none of that matters if investors can actually profit from their recommendations. So how are we going to assess that? So we start by looking at short window returns. So here what we're going to do is we're going to examine buy and hold abnormal returns, 5 by 5 by 5 adjusted for both upgrades and downgrades. And we're going to look at that for both traditional analysts compared to robo-analysts. And so what do we find here? Well, let's start with the traditional analysts. With the traditional analysts, we find the pattern that's been documented in the literature, that following a traditional analyst recommendation revision, when it's an upward revision, the positive and significant reaction. When it's downward revision, there's a negative reaction. With respect to the robots, though, it's far less clear. We find that in the short window surrounding a robo-analyst revision upward, there's a positive but very weak in terms of statistical significance and economic significance market reaction. And there's no evidence of any market reaction surrounding a downward revision. So obviously you can look at these numbers here and say, well, the traditional analyst is obviously having a much larger upward revision and a much more negative reaction for the downward revisions. So in other words, we're seeing very limited evidence that investors are following robo-analyst recommendation revisions in the short run. So what are potential explanations for that? Is it potentially the case that robo-analysts have less investment value? That could be one explanation. It could also be the case that they're just simply less visible. We don't necessarily know about these robo-analysts. We do know about the more popular analysts, let's say at JP Morgan or Goldman Sachs. And finally, it could just be the case that investors are averse or wary of following machines or robots. So there could be some algorithm aversion. So the last part of our study tries to dig into these explanations a little bit more by really trying to see if we can actually generate investment value in a portfolio strategy. So what we're going to do here in the last part of our study to really explore the investment value of robo-analyst recommendations is we're going to examine long window returns. We're going to follow a pretty common methodology in this literature by Barber et al., who will form daily portfolios based on the buy and sell recommendations issued by robo-analysts versus traditional analysts. And then what we're going to do is we're going to look at abnormal returns, which are obtained by regressing raw returns less the risk-free rate on either the Fama-French 3-factor or 5-factor returns. Okay, so let's first look at buy recommendations. So here you can see the robo-analyst and traditional analyst and the difference using both the Fama-French 3-factor in the first 3 columns and the Fama-French 5-factor in the second set of columns. What we find here is that robo-analysts generate significant alpha in both after the Fama-French 3-factor and with the 5-factor adjustment, and that this difference is significant and larger than the traditional analyst advantage. So we're comparing 2.7% versus about 0.5% in columns 1 and 2. So it's rather substantial. On the flip side, though, when we turn to sell recommendations, we don't find the same evidence. So we find that the traditional analysts, they have a negative but insignificant reaction, and the robo-analysts have no impact here in our study. So, you know, it was a little puzzling to us why we found this result at first, but one explanation, a couple explanations, but one is that the robo-analysts are simply focusing less on sell recommendations because a lot of their clients tend to be retail investors who are less likely to short a stock. It could also be the case that in trying to have balanced recommendations, they may be overdoing it and just issuing too many sell revisions. But for whatever the case is, we do find that only their buy recommendations seem to offer a profitable trading strategy. Okay, so I'm just about out of time, so I'm going to wrap up here. So just to conclude, where we are in this paper is we see that we see from a lot of studies and a lot of news that fintech is really important in revolutionizing the financial services industry. So what we do is we provide a rather, admittedly a descriptive exercise, but we really want to provide the first comprehensive analysis of how fintech is changing equity research. And we're going to do so by studying Robo-Analysts. And so the takeaways from our paper is that we can see that Robo-Analysts produced a more balanced distribution of recommendations. And they have a very different process. They revise more frequently and are more likely to incorporate information from public disclosure. In terms of their value, we find that in general, their buy recommendations seem to add value, but their sell recommendations appear to be not as useful. And that this is really only evident in long-term trading strategies. You can't see that in short-run reactions. So we think that one implication from our paper is that automation appears to be benefiting investors that are relying on equity research. Sorry, Alberto, I think you're unmuted.
Oh, sorry. I've been talking for like 10 seconds. So I think, yeah, if you can stop sharing your screen, that would be great, because I think your camera doesn't work on
the sorry about that. My camera broke.
No problem. I mean, it's so small anyways in the recording. So, so we have a number of comments. Let me start from, I think that the more kind of data oriented one. So Rama Maladi asked, can you please point us to the 7 firms' language where they disclose that they use machine learning? What if a firm discloses somewhere else or does not disclose? And I have like a similar kind of question for you. Do you have any evidence of maybe having some hybrid structures where people? Are you there? I cannot see.
Oh, yeah, I'm here. Sorry. Yeah.
Okay, sorry. Do you have any evidence of some sort of hybrid structure where the algorithms complement the decisions of the human analyst, or you don't have any sort of evidence along those lines?
Yeah, so I can talk to both of those issues. I mean, so first, the hybrid structure thing is something pretty interesting that we've been thinking about and discussing for follow-up projects. I do know that some of the traditional research shops are beginning to incorporate big data and have a type of things similar to this in their process. But for the most part, they're still the main kind of decision maker is still a human analyst. So we're not really focusing on that in our study. We're focusing on, in terms of the details, what we do is we go into Thomson 1 and we look for, I think it's non-broker research. So these are the non-traditional brokers. And I forget how many are in there, but we went through each of the business models and we're looking for, we have a dictionary. We're looking for words like NLP or analytics or big data to confirm that they're actually seem to be Robo-Analysts. We do provide this, I think, in the appendix of the paper. So I think the 7 research firms, we provide their business strategies. I'm happy to share that with the person who asked the question as well.
Mm-hmm. Yeah, I think kind of there is a second question. I mean, there is a question that is related where Jim Angel is asking, how can I access this data from my Interactive Brokers account? But I don't know if you know the answer to this.
So we accessed it from Thomson 1. So we don't have a subscription anymore as of June, but we used to have a subscription. So we accessed it from Thomson 1. Happy to kind of share that process as well.
Okay, so another question comes from Wei Wang, who's asking, will Robo-Analysts be more affected by the media? It will be interesting to see if Robo-Analysts respond more or less to market sentiment change.
Yeah, that's a really interesting. I mean, so from the firms we've looked at in our sample, especially new constructs, that doesn't seem to be the way they're operating. They seem to be really trying to process and digest disclosure as rapidly as possible and populate their models and get the information to their investors. I've heard of like investment strategies using sentiment like from Twitter and whatnot, but I don't think we have any evidence that the Robo-Analysts in our sample, that's a strategy they're really employing. But it's definitely an interesting kind of thought.
I see. Then we have another question. This comes from Mark Apsey. He's saying, novice question, but do these models account for investor sentiment? That is momentum in making their determinations, or do they run strictly on disclosures?
Yeah, so it's something we could check up on for the robots in our sample, but for most of them, I think they're relying strictly on firm disclosures. And at least in our empirical evidence, we are finding that there's this heightened likelihood to revise following the public disclosure. But, in kind of combining a couple of these questions here, it wouldn't be difficult for us to kind of test this as well. We could try to look for changes in sentiment or changes and see if there's any revision happening around those days as well.
I see. And then we have two more questions, and then we have to move to the next. We have Mark Purkowski who was asking, is the investment horizon for the recommendations similar between robo and human analysts?
That's a good question. I think we were operating under the assumption that they are similar because they are trying to compete with the human analysts. But even with the human analysts, I do think some of them do have different horizons. So it's a little bit difficult to say that they're all for sure strictly 12 months.
I see. Okay, and so the last question is coming from Charu Agarwal, and she's asking, do robo-analysts include stocks excluded from analysts' buy recommendation, or do they only refine the analyst buy selection further? I think this kind of goes back to this kind of hybrid structure. So I don't know if you have any additional comments here.
Yeah, so I have a couple of comments there. I know that some of the robo-analysts in our sample, kind of the way they're trying to compete and position themselves is they would like to have their product be the starting point for the traditional research analyst, kind of start with our models and then, use your soft information, your judgment to produce the recommendation. So I think that's kind of one thought on that. And I'm not sure if I completely understand the question, but I just want to clarify that our sample, we don't actually look at the recommendations that are produced by robots and not from humans. So we can't speak to the coverage of a stock that the humans aren't covering in this paper.
I see. Okay, that's perfect. I think this is a fantastic natural
story.
story.
I'm sorry again about the camera.
Oh, no problem at all. Thank you so much, Joe, for the great presentation. And let's move to the next paper, who's going to be presented by Xiang Zheng. Xiang Zheng is a job market candidate from Boston College. The title of the paper is How Can Innovation Screening Be Improved? A Machine Learning Analysis with Economic Consequences for Performance. So we're going to move away from stock earnings, and we're going to go into patent quality. Xiang, please feel free to start whenever you're ready. You have 25 minutes.
All right. Thank you so much for having me, especially thanks, Alberto. It's really my great honor to be able to present my paper here at Georgetown. So my paper analyzed the economic consequence of inefficient patent screening on firm performance. So the patent system is viewed as one of the most important institutions that contribute to technological growth in the economy. And this is also emphasized by the US Patent Office itself, which I quote here: the strength and the vitality of the US economy depends directly on effective mechanisms that protect new ideas, investments in innovation and creativity. However, the system has also been criticized for granting too many low-quality patents that may otherwise reduce firms' incentive to innovate and or create unintended problems such as patent choice issue. And many factors may have contributed to this phenomenon. First of all, patent examiners have faced increasing time constraint over time. So for example, here I plot the total number of patent applications filed at the US Patent Office and the total number of patent examiners worked in the office over the last 2 decades. As we can see, the number of patent applications filed at the office has increased dramatically from around 300,000 patent applications filed back in 2001 to more than 600,000 patent applications filed more recently every year. So inevitably, patent examiners need more time to review a new patent application given the increasing number of existing patents for them to compare and analyze. However, the number of patent examiners has not increased as much as patent applications. And in addition, the US Patent Office actually sets expectations regarding the amount of time patent examiners should spend on each application. So typically, patent examiners on average only spend around 19 hours for reviewing one patent application. So as a result, patent examiners face an increasing time constraint due to the increasing search and rejection efforts. And what's worse here is that the problem faced by the US Patent Office actually goes beyond the time constraint issue. The US Patent Office also faces human capital constraint. So for example, in Jeffrey and Leonard 2011's book, they point out that the Patent Office fails to recruit and retain the best patent examiners due to fierce competition from the private sector. So as a result, underpaid, inexperienced, and overworked examiners are given flawed tools for finding and searching existing patents. So, however, the above constraint faced by the US Patent Office and the resulting weak screening process actually provide a natural setting where machine learning can potentially offer help as a robo-advisor. So in this paper, I developed a machine learning algorithm to analyze whether the pattern screening process can be improved without changing the current system itself. So in particular, I trained a supervised machine learning algorithm to learn pattern quality using earlier pattern applications, and I then predict the quality of more recent pattern applications out of sample. And I will show that such an algorithm is actually able to do a better job compared to actual examiners in terms of granting high quality pattern applications. And quantitatively can reach as much as 16% gain in quality compared to decisions made by examiners. And next, in the second part of my paper, I also studied the economic consequences for firms who get patents from an inefficient patent screening process. So to do so, I first label patents that would be rejected by a machine learning algorithm to be falsely accepted. And I then construct an ex-ante screening efficiency measure by computing the past false acceptance rate of each examiner. So first of all, I found that falsely accepted patents are more likely to expire early. So here, when patents get granted, the holder of the patents have to pay renewal fee every 4 years up to 20 years maximum. So this result suggests that the holder of these patents are more likely to voluntarily give up those patent rights, or in other words, these patents are not very useful for firms. And lastly, I also find public firms whose patents granted by examiners with a high false acceptance rate are more likely to have worse operating performance going forward. And these firms are also more likely to get sued in subsequent patent litigations, and they cut R&D as a response. And also, when those patents get granted, their firms have lower announcement return around those patent grant news. And in the case of private firms, those private firms who get patents from such examiners are less likely to exit successfully by an IPO or a merger acquisition. So in terms of related literature, first of all, my paper related to those legal literature that explore the question of improving patent screening process by reforming the patent system itself. So for example, Dreyfus 2008, they proposed that in order to reduce the number of low quality patents get granted, we should increase in the patenting threshold. Or other papers like Matthew et al. In 1996, they also proposed to change the optimal patent rights in order to increase the patent quality. So unlike this literature, my paper tried to explore the possibility of improving patent screening without changing the current system itself. Here, in this paper, I control for the same grant rate. And also, my paper is related to the emerging literature that apply machine learning algorithm to economics and finance research. So I pioneered a paper by Kelley et al. 2017. It's QDA paper that compare New York judges' decision over bailing cases to machine learning prediction and lay out potential challenges when you apply machine learning to social science research. And also, Carroll et al. Recent paper, they're using machine learning to select board of directors. And there are many papers using machine learning in the asset pricing context. For example, estimate risk premium, classify fund types, and predict stock return. And lastly, my paper is also related to the traditional innovation literature that studies the relationship between corporate innovation, stock market valuation, and firm performance. For the interest of time, I will skip discussing these papers. So overall, my paper contributes to literature by analyzing pattern screening efficiency using machine learning, and I will also provide some direct evidence on the economic consequence of inefficient pattern screening on firm performance. So now let me discuss a little bit about the patent examination process. So the patent examination process starts with the filing of a patent application to the US Patent Office. Then the office will forward this application to the relevant art unit for examination. So an art unit is a specialized technological group that's relevant to the patent application. And one interesting feature here is to avoid potential agency problem or revolver door issues, patent applications are actually randomly assigned to each examiner within the art unit. So basically, an application with the earliest filing day is assigned to the first available examiners. And some recent papers have made use of this feature to establish quality in their research. I will also rely on this feature to help evaluate the performance of a machine learning algorithm. And then in the last step, each examiner compare the claimed invention to existing patents to make the grant decisions. In terms of the patenting criteria, the US patent law requires a granted patent to be new, useful, and non-obvious in order to fulfill the mandate of a patent patent and a copy clause of the Constitution. So the purpose of this Constitution is to make new discovery public knowledge by rewarding inventors with a limited exclusive rights on their invention. So therefore, the grant of a patent based on the patent law actually hinges on the prediction of its future social value to the society by a patent examiner. And I argue that the same prediction problem may be solved better with the help of machine learning algorithm. I know some of us may ask, is the objective of patent screening process to only protect the most innovative ideas or just to meet the minimum patenting requirement? Actually, the US, in terms of this question, the US Patent Office has its own answer. For example, the office in their 2018 to 2022 strategic plan, they states that the most important goal for them is to continue optimizing patent quality. So we probably would agree at the very minimum, the system should not discard better ideas in favor of worse ideas to the extent that better ideas also satisfy the minimum patenting criteria. In terms of measure patent quality, I follow the existing literature and adopt patent generality as a measure of patent quality. So first of all, patent generality is a citation-based measure that captures the social value of a patent. And so in order, I try my best to mimic the objective of patent examiners. So in addition to compared to simple citation, the generality of a patent also captures the industry dispersion of its citing patents. So for example, if a patent in chemistry is cited by later patents in biology, medical science, and engineering, we would expect this patent to have higher generality than a similar patent that receives the same number of citations, but all from patents in one field. In particular, the generality of patent I is computed as follows. Here, the second term on the right-hand side of the equation is actually the Herfindahl-Hirschman index of its citing patents measured over a 4-year window across different industry after the patent get granted. So basically, the generality of a patent is the inverse of the Herfindahl-Hirschman index of its citing patents across different industry. So in terms of data, I collect data on both rejected and granted applications filed between 2001 to 2018 from the US Patent Office website. And all this data are recently available. So my paper is actually the first set of the paper try to use this data. So in particular, I collect the patent examination data, which include information on patent examiners' name, their decisions, the application's filing day, decision day. I also collect the patent application text characteristics and the patent renewal behavior data, and the patent assignee data, and the patent citation data. Accounting and financial data are from conventional sources like Compute Data and CRISP, VC and IPO data of private firms are from Venture Expert. So now I will discuss in detail how I develop and validate a machine learning algorithm. So my machine learning prediction follows 4 steps. First, I will partition my sample patent applications into training data and test data. The second step is to train a machine learning algorithm using training data, and the goal here is to construct a prediction function that predicts patent quality well out of sample. And the third step is to evaluate its out of sample predicting accuracy using out of sample test data. And the last step here is to test whether this prediction function can identify some problems or improve examiner's decision. So let's move to the first step, sample partition. So I select the patent application filed between 2001 to 2005 as the training data, and select the patent applications filed after 2010 until 2013 as the test data. So there are a 4-year gap between the training data and the test data. Because this time period, I need to use them to collect information on my outcome variable patent generality for the training sample. And my test sample is also end early compared to the data available to me, because I also need to collect information on the actual outcome variable for the test sample. So in the end, I have around 280,000 patent applications in the training data and around 350,000 patent applications in the test data. So before I move to the second step, I want to briefly talk about the difference between, let's say, OOS and machine learning. So in our traditional statistical tool, we assume ex ante a specific relationship between X and Y. In the case of OOS, we assume linear relationship. We put a lot of weights on estimating beta, on bias, or address endogeneity issue. We have less focus on predicting what has. However, unlike the traditional OOS, or statistics, machine learning algorithm let the data to tell the relationship between X and Y, and focus only on predicted Y hat well out of sample. So in terms of training the algorithm, like I mentioned earlier, the outcome variable I use is called pattern generality, and I include a lot of different input variables. So the first set of variables is I convert the pattern text into a numerical vector to capture the text similarity across different pattern applications filed during the same time. And I also include different types of pattern citations made by this pattern application, number of novel words, dummies, capture the filing year, inventors, technological class, and R-unit. In terms of prediction function, I'm using extreme gradient boosting tree algorithm. I think Jules has a very detailed description how this type of algorithm works. So the reason I choose this algorithm is this one gives me the highest predicting accuracy among those algorithms I have tried. So now let's move to the third step, which is to evaluate the out-of-sample predicting accuracies. So what I do here is I plot the correlation between predicted generality and the actual generality among the pattern applications in the out-of-sample test set. So here the left panel is produced by machine learning algorithm, and the right panel is produced a simple OOS where I regress the pattern generality on all my input variables. As we can see, all the data points in the left panel are centered around the 45-degree line, suggesting the correlation is quite close to 1. And in the right panel, the correlation is much lower. So this comparison suggesting that machine learning algorithm can outperform a linear regression over the entire test sample. And in addition, I also compare OOS to machine learning in terms of identify top quality patterns. So what I do in this table is I ask both machine learning and OOS to give me the top 1% sample according to their predictions. Amazingly, what I find is that the top 1% sample identified by machine learning is actually 80% difference from the top 1% sample identified by OOS. And if we compare their actual quality, the actual quality of the top 1% sample identified by machine learning are actually significantly higher than the actual quality of those samples identified by OOS. And this is also true if we move the threshold to top 5%, top 10%, top 25%. Now, let's move to the last step. I guess this is the most important figure I want people to remember. So here I want to ask the question, do pattern examiners reject high quality pattern applications? So what I do here is I plot all the pattern applications in the out of sample test set against their actual grain rates. So in particular, I divide all applications in the out of sample test set into 1,000 bins based on predict generality, and I calculate the grain bin in each grain rate in each bin. As we can see, indeed, examiners, these are actualizations. Examiners accept more pattern applications in those bins with high predicted generality. But if we take a close look, it's not 100% acceptance rate. So they still reject, for example, the point I point out here is more than 10% of the applications in this bin get rejected, even they are with a very high predicted generality. And if we move to the left corner, we see those bins with the lowest predicted generality, they are around more than 50% of the application get accepted. So my next question is, can an algorithm do a better job than pattern examiners in terms of granting high quality patterns? So ideally, we want to compare the average quality of pattern applications granted by an algorithm to the average quality of patterns granted by examiner. However, we do not observe actual quality of those applications. They are actually rejected by examiners, but would be accepted by my algorithm, because once an application gets rejected, there's no way you can collect the generality information for that application. So instead, I will make use of the quasi-random assignment of pattern applications to pattern examiners with different grain rate. So what I do first is I divide the examiners equally into two groups based on their leniency. So more linear examiner and less linear examiner. And presumably, more linear examiner accept a higher percentage of pattern applications than less linear examiner. So here is an illustrative example. For example, let's say there are 2,000 pattern applications sent to random sent to more linear examiner and less linear examiner. 1,000 applications sent to more lenient examiner than 1,000 patent applications sent to less lenient examiner. Let's also assume more lenient examiner accept 70% of the application and less lenient examiner accept 50% of the patent application. So in the end, there will be 700 patents granted by more lenient guy and 500 patents granted by less lenient guy. So what I do is I set the grant rate of less lenient guy as a benchmark. So I will rank all the patents granted by more lenient guy, and I reject additional 200 patents from the lowest predict quality to make the grant rate here the same as the grant rate of less lenient guy. So then I can compare actual characteristic of these 500 patents with these 500 patents. So here's what happened in the real data. First of all, I plot the quality distribution of applications rejected by more lenient guy. Those black bins are the rejected application by more lenient guy. We can see, say, although they reject less percentage of applications in those high quality bins, but they still reject some of them. And I also plot a similar quality distribution for made by less lenient guy. They reject more application, and they reject more application both in low quality bins and high quality bins. And if we plot these two figures together, we can see less lenient guy reject additional applications all over the place, both with lower quality and high quality. So now what I do is I ask the algorithm to reject the same percentage of additional application as the less lenient guy compared to more lenient guy among the patents granted by more lenient guy. So the machine learning algorithm can reject from the lowest until hit the grant rate of less lenient guy. So what I do is I compare all the patents in this gray area granted by more lenient guy and shrink by my machine learning algorithm to the actual patents granted by less lenient examiners. So such comparison enables me to quantify the quality gain. For example, there will be 16% gain in generality or around 30% gain in patent citations. All right. So in the second part of my paper, I analyze the economic consequence. I also analyze the economic consequence for firms who get patents from an inefficient patent screening process. Like I did in the first part, I will label a patent to be forced to accept if it's accepted by a human examiner, but would be rejected by a machine learning algorithm. And I then construct an ex-ante screening efficiency measure for each examiner by computing his or her past forced acceptance rate. So for example, the forced acceptance rate of examiner J is the total number of forced accepted patents by him or her divided by all the patents he or she, all the patent applications he or she has reviewed. So for the interest of time, I will skip summary statistics. Let me show you a couple of tables. So the first table I show you is I regress the subsequent ROA on this quarter's screening efficiency of examiners. What I find that firms who get patents from an inefficient patent examiner or examiner with high forced acceptance rate, they end up have worse operating performance going forward. If this forced acceptance rate goes to 0, there will be resulting a 2.1% increase in annual ROA, which is in terms of magnitude. And I also try to test the channel. What I find is that those firms are more likely to get sued in subsequent patent litigations, and those firms cut R&D expenditure. And I also tested the announcement return around those patent grant use. I found that patents granted by examiners with high forced acceptance rate have lower announcement return. Lastly, I also look at private firms' performance and measure performance of private firms using successful exit by either IPO or merger acquisition. What I find is that private firms who get patents from inefficient process are less likely to get exit successful by an IPO or merger acquisition. So lastly, I did a patent level regression to test whether those forced acceptance patents are more likely to expire early. Like I mentioned earlier, in order to maintain the patent rights, you have to pay renewal fee every 4 years up to 20 years. Here, what I find is that forced acceptance patents are less to get maintained in the 4th year or 8th year, and they are more likely to expire early because firms don't want to pay the maintenance fee. All right, to wrap up, in this paper, I developed a machine learning algorithm to evaluate patent screening process for the first time in the literature. And I want to argue that this algorithm is able to do a better job in terms of granting high quality patent applications out of sample compared to that under the current patent screening process. I also document that the economic consequence of inefficient patent screening is large and significant for both public firms and private firms. So the potential policy implication is that machine learning algorithm can serve as a robo-advisor in assisting human examiners to make better decisions. And here, I don't want to argue, say, we should replace the system with an algorithm, but algorithms serve as a assisting or supporting tool. Thank you so much.
Thank you so much, Xiang, for the great presentation. And yeah, so I actually wanted to touch on the very last point. So your policy advice. I mean, like, and this is kind of an open debate, but I have, for me, you know, like robo advising is very close to my heart. But do you think that in the future we should expect some sort of hybrid structure where you have a human patent examiner that is held by the algorithm, or do you see that instead you're going to have kind of at some point the machine is going to take over?
I think at the very minimum, patent examiners should still take the lead. So what in my mind is those algorithms can serve as a double check. When there's a patent where examiners have struggled to review them, they can take a look at the machine's prediction to take a more careful look about this particular patent application. Because if we change the system with an algorithm, there will be some unintended consequence. For example, speaking from the supply side, they may figure out how this machine can predict or game the system or change the equilibrium. So in my mind, the machine can serve as a supporting tool, not as a leading law.
Mm-hmm. Okay, and then I have another question. So what, and maybe you went over this in your presentation, but it seems to me that you kind of train your algorithm on all patents, but you may think that some features are going to be more or less relevant in certain sectors. So you can also think about having a algorithm that is trained on different types of patents. I don't know if you've done this.
That's a very useful suggestion. I haven't done that. That's definitely a useful suggestion. I should probably work on this as well.
Okay, perfect. So we have a couple of questions from the audience. So Daisy Wang is asking, a falsely granted patent would at most do no good to the firm, but your results seem to show the firms with such patents are cursed by the patents and they tend to do worse. Can you explain how we should think about this result?
Yeah. So I should explain more clear. Here, the benchmark is not compare a firm get a patent falsely accepted with a firm doesn't get a patent accepted. Here, what I compared, let's say there are two firms, the same number of patents get granted, but one firm's patent get granted by a higher fraction of examiners with like inefficient past performance, while the other firm's patents are granted by more efficient examiners. So in that sense, on average, those patents granted by examiners with high false acceptance rate on average low quality. So low quality patents may do harm to the firms because firms may have struggled to developing those technology over those patents, or it turn out to become a negative NPV project for those firms. That's what I have in my mind.
I see, perfect. Then we have a question from Sahid, which I think is a little bit more of an institutional question. He's asking, does the system allow a firm to apply for more than one patent? So how does this kind of, how does this patent application work? So how many patents usually companies apply for on a given year? Just to give us a sense of the ball numbers.
That's a great question. So in my sample, those public firms, they actually apply multiple patents, even in a given quarter. Like think about Apple or Google, they submit huge amount of patent applications. On the other hand, private firms, they almost rarely submit that many patent applications. So what I do deal with this issue in my regressions, I take an average among all the patents in a given quarter to see the average efficiency, because sometimes, like the question, firms submit multiple patents.
I see. Perfect. Then we have a question from Danking May, and it's kind of a long question. I'm going to send it to you via email afterwards. But the gist of it is that I think what he's saying is that you may have that the features may change with the relevant features may change over time. So one question that you may, or even a suggestion I may have is like, like how should we think about training these algorithms, right? So we may think that we want to use all the patterns. So maybe we want to use kind of only the most recent patent. But have you thought about how to think about this problem?
Yeah, that's a very fair question. So what I want to say is this is like a demonstration, because I want to show train using early, but test using recent can do a better job. But one way I want to also direct answer this question is, I have a very direct way to test whether the algorithm doing a better job or not by compare the out of sample predicting accuracy, right? But let's say the US Patent Office, believe my story, they want to adopt this technology. They should train using a rolling window, more recent data. Because here, for the research purpose, I intentionally using very early data, try to avoid potential agency, future. I try to avoid the machine learning algorithm using future information, make an unfair comparison between machine and algorithm. But that's a very fair question.
I think there are another couple of questions in the chat, but I'm going to send them to you.
Sure, no problem.
And then you can respond to the persons that reach out to you. Let me take a moment to thank all the audience and the speakers. I think the papers were fantastic and the comments were also great. I'm very excited about the next event, which is going to take place next Friday. It's going to be Natural Language Processing Day. I hope to see you there. And in the meantime, have a wonderful weekend, and I'll see you next week.